In this video, we'll look at using leverage when trading crypto. I'm going to go through a strategy of actually setting up your leverage position, how a professional would think about this in terms of the risks that you're taking, how much leverage you want to take, how to actually take it as well in a step-by-step guide. So I'll leave all of the timestamps down in the description. I'm going to use Binance for this one just to show you because this is kind of the industry standard in terms of crypto trading platforms. And so if you're using Binance or another platform, it will look a little bit like this. And so you can just put that over to your platform. I'll leave a link to Binance in the description if you're not with them yet. They give a deposit bonus if you trade futures and leverage, so check that link out if you want. Firstly though, we need to understand what leverage trading is and how it works specifically. Now, most platforms, including Binance and others, will let you leverage trade in two different ways. So I'll quickly go through them here. The first one is through margin and the second one is through futures. Now, they're doing basically the same thing, which is lending you money to trade with more money than you have. But with margin and futures, it's a little bit different. Futures are a specific product that you can trade. Margin is essentially just borrowing the money to trade normally with the way that you would do it in the spot market. Now, most people trading on leverage will trade with futures simply because the trading systems are a little bit more robust and it's kind of easier to get around trading with futures than it is with margin. Nothing wrong with margin, but there are some slight differences here. So on Binance with margin, you can trade with 3x or 10x leverage. So if you put 1,000 in, you can obviously get anywhere from 3 to 10x leverage. That depends on how your margin is given to you, known as isolated or cross. Right, so cross margin is usually 3x, isolated margin can go up to 10x. That means that each position, when it's isolated, is margined separately. Cross is when you borrow money to fund all of your different positions. And so isolated is a little bit less risky, so they can give you more margin. You obviously pay an interest rate here, around 3 to 10%. It depends on the platform, but you can quite easily see this. So go to something like Binance or whatever exchange you're using and look for the data right here. Search for the crypto that you want to trade. For example, Bitcoin, you can see they charge 3% here for regular users. But if you have other smaller coins, they're going to charge you more interest because that's just the way it is. They're more volatile and they're smaller markets. Now for futures, you can actually trade anywhere from 0 to 10x margin, actually way more than that, up to 125, but that depends on many factors. When you're borrowing money, you don't have to use 3 or 10x or anything. You can essentially just create a position size that you want. So even if you're getting loaned 3 times what you put on the system, you don't have to open 3 times. You can do whatever you want in terms of your position size. So just to give you a kind of overview of what you would be doing with margin, as you can see here, if you had $1,000 of Bitcoin or you had $1,000 to open a Bitcoin position, with margin, they just lend you money and you can open a bigger position. I'm going to go through some of the pros and cons of this and how to analyze how much you actually want to take. But as you can see here with margin and leverage, if you have no leverage, then $1,000 position moves 10%, which is obviously $100. If you're using margin and leverage to borrow money to open a bigger position, then that same 10% move is actually $300, right? And that means that the amount of percent move makes a much bigger difference to the underlying investment that you have because you only have $1,000, right? And you're borrowing money on top of that, and a larger position, the same percent move will have a much higher nominal move. So as you can see, if you actually have $1,000 and you take 3x leverage on that, you're actually going to get wiped out around this level here if it moves against you. So let's call it 35% move, something like that, 33.33% probably. That is actually going to wipe your entire position out. So a 33% move to the downside, your initial position totally wiped out, okay? So everything's gone, you'll get liquidated on the system. Conversely, obviously if you go up, you can see there's a big difference in terms of your profits as well. So what does leverage do? It just amplifies your profits and losses compared to your initial investment versus not being able to take leverage. Now I'll concentrate on trading futures as most people will want to trade this with leverage. There's 2 ways to fund your account, which is what you're doing, putting collateral on to fund the loan that they're going to give you. There's 2 ways to do that. The first is coin margined and the other one is stable coin margined. You can come up to the top and actually choose these. So you can see this option right here, USD, SM and CoinM, US dollar stable coin margined. That is The loan that you're going to take out when trading, if you use leverage at all, you don't have to use leverage with futures. You can use 0x or 1 times, which is just the same as you have. But if you are going to take leverage and use margin, then you can fund that margin with a US dollar stablecoin. So you can put $1,000 on here, which is obviously not a risk asset. And so that will always be $1,000. And then you can fund your positions that way. If the risk asset moves, you can fund your positions with your dollars. The other way to do it is to use CoinM. So if you click here, you can see these markets. Now, this is when you use a crypto to fund your position. So you can actually put, for example, 1 Bitcoin or half a Bitcoin on there. And the value that it has will be used as the collateral to fund your loan, essentially. Now, coin margin is obviously way more risky because you're now using a risk asset to fund your loan. And if you're funding a long position with Bitcoin and the position starts to move against you, not only is your trade down, but your collateral is also down. And so obviously with a down move, you can get stopped out much quicker because both your collateral and your position are losing. Whereas with US dollar stablecoin margin, you're not doing that with the dollars. And so you're only getting one position move against you. Obviously, if things go your way, then it kind of doesn't matter either way. But yeah, coin margin is definitely slightly more risky and volatile than using a stablecoin. Now you can choose between cross or isolated margin. Like I said, cross margin is when you have collateral that funds all of your positions simultaneously. Isolated, each position individually needs to be funded. Now you can come up to the top right here and click on this and it will bring up the options for you. Again, this is for Binance, but other platforms are going to be very similar and you can see them explained here. Now, isolated, you can use more margin for each position because if a position moves against you, that particular position will be wiped out. You'll be liquidated, but your other positions will all still be funded. Cross margin, means that if one of your positions goes bad, it could be potentially funded by the margin that you have for other positions. So most people will go to isolated margin because they want to trade one thing at a time and they don't want any of their other positions wiping out other potentially profitable positions. All margin and leverage positions are treated separately, so they're in a separate account from all of your spot trading. And so it's good to just have them split up here. So if you come down, you can come to assets and transfer. So you want to press transfer here. And then what you can do is transfer in some funds from your fiat and spot account into your futures account very easily. So whatever that is, you can also, if you're using margin, so you want to use the margin trading platform, you can, put that into cross margin or isolated margin accounts. That's a different platform. So we won't go through that in this video. We're just going to stick to futures, but yeah, get some assets into your futures trading account. And that is what is used to actually fund your positions. Now, what you can see here is a margin ratio. Margin ratio is just very simply how much money and cash that you have in order to fund your positions. Now, if you're using 3x leverage, then your margin ratio can be really, really healthy because maybe the positions are in a profit. And so there's plenty of account balance and account profits to fund all of your positions. Now, if you're getting into losses, then again, your collateral is just there to fund your losses. And so losses will never exceed your initial capital because the system is going to trade you out and restrict you. So it's really important to understand these levels as well. Come to your platform's TNCs. This is Binance is here, and they'll tell you exactly how they manage your account. So as you can see, if you've got a margin level of 2, so let's say you have $1,000 in your account, you opened a $3,000 position, the position's up 10%, you're great because the positions are up and you've got plenty of account balance to fund your positions. And so you can do everything here, as you can see. Now, if you're starting to make losses, that's when the amount of margin is starting to exceed your ability to pay it back. I mean, it's still fine here at 1.5 times and 1.3 times, but as it gets down, as you can see, they'll start to limit what you can borrow and fund further. So they actually start, essentially wanting you to cut down your positions and fund them, even if they're in a loss. So you might start having to take some losses here. And right here, as you can see, and this is the same for most platforms, when your collateral is around 1.1 times, so you've got 10% more collateral than you can actually use to fund your positions, they'll start liquidating you essentially. So they'll give themselves a buffer when your 1.1x, your actual losses, they'll start liquidating to make sure that it doesn't fall below that. So you can lose all of your money when taking leverage. They won't let you go into debt though, as you can see here. So good to know, and make sure that your margin level is also healthy so that you can trade properly. You can also use the calculator on each platform to understand how much risk you're taking and your potential P&L. You can do that in every platform up here. There'll be a calculator icon in most platforms. And the ones that I really look at is P&L, and liquidation price is a really big one as well. So P&L is very simple. Put in a price that you would open your position at. So let's say 19,950, which is around where the price is right now. And you want an exit price. If you're going long, you might want to take profits at 20,000 or something like that, 21,000, and then the quantity as well. Now, I'm going to show you how to work out the quantity based on how much risk that you want to take. But as an example, just put 1 BTC. You can calculate, what the initial margin would have to be in terms of how much leverage that you want to take, right? So in this example, we're using 2x leverage, which isn't a ton of leverage. You can see that the initial margin that we need is around $10,000. So if you want to open a position of 1 BTC, which is around $20,000, you only need to put up around $10,000 because you're using that margin from the brokerage. If you're using 1x leverage and calculate, you have to completely fund the bet. And if you go up to further to kind of 10x leverage or something like that, you just need to put smaller initial margin down. This can be beneficial for people that have an account and they're using, for example, Ethereum, where you have ETH staked in the blockchain and you're earning 5% yield off that, and you want to trade it short term or you want to trade around the edges, you don't really want to lose that 5%. And so what you can do is maybe take a smaller amount out to fund positions that you want to trade. And so you can use less of your HODL portfolio to express your opinions in this market if you want to trade short term. When you trade on leverage and borrow, and definitely with futures, you can go long or short, and I'll show you how to do that now. Going long is the same as buying, expecting the price to go up for you to sell it in the future at a higher price. What's great about futures trading platforms is that you can use these forecasters, so a long position here. So let's say that we're going to go long around this level, which we're at right now, and you want to take profits at some point, and you can put your stop loss down here, and you can actually see what the P&L of the position is before getting into it. It's a great calculator, and so dependent on your technical analysis, you can do this, and then that's going to give you your potential risk. Now from this, we can work out how much leverage we want to take in terms of how much risk we're putting compared to our overall portfolio. So I'll go through that now. So dependent on technical analysis, let's say I've done this and I'm going to put the stop loss, around this support level. I want to be taking a target around here. I can see how much I'm actually putting at risk in terms of the nominal amount and the percent. From there, I can determine how big I want my trade size to be. Based on your technical analysis in terms of your entry price and your max potential loss, you can now work out how much risk you want to take. There are some general ways of doing this, so I'll go through that now. Also, I'm not going to go through technical analysis in this video, but I do have some other strategies and tutorials. I'll link them in the description below for YouTube. If you want to get a bit more professional, we have a total trading section in the Crypto Investor course. You can see it here, which goes through analyzing charts, technical analysis and trends and everything. I've also got an entire section on futures and options as well, as you can see here, with trading strategies. So if you want to get a bit more pro, definitely look at that. I'll link it in the description. But as an example here, let's say you've done your TA and you've seen that this is a potential max drawdown that you're willing to take on a long position. So we'll look at a long position as an example. So we go in here and this is our max loss. Now you can work this out by your entry price and the max potential loss or your stop loss. I'll show you how to do a stop loss as well, but we want to get our position size first. So we can see that our opening price is 19,663. So what you can do is go to a position size calculator. There's many of them online. You can just go and search for one. Check out this one as well. You want to get the instrument right, and then the deposit currency. So I'm using US dollars here to trade against, and then the open price. You want to get these into where your position is. So see the opening price that we got is, let's call it around 19,663. So 19,663. And then the stop loss price is really important because that's your max potential drawdown. So if the trade goes against you, how much you're going to lose, how much do you have at risk here? And so you can use this calculator that we've done to say, this is our stop loss. Let's move it up a little bit to here. That is around 17, call it 18,000. Okay, so we can put that in. And then the account balance that you have, this is how much your trading account is. I would say your HODL portfolio is for that, and then you have a trading portfolio and a trading account for whatever you want to put in there. So let's just call it 10,000. Now, most traders will say for each individual open position that you have, you might want to risk anywhere from kind of 1 to 3%. In an average of 2%, right? That is a good as a basis just to get a level. So if you calculate this, you can see how big your trade size can be. Unit trade size is 0.12. Now, if you're really confident of a trade, or you're seeing from technicals that, you know what, I'm just really confident of this trade, then why go in 2%? You might want to put this up to maybe 3 or 4%, calculate that. You can see the trade size obviously doubles, right? Because you've doubled the max potential drawdown. But yeah, as a guide, most traders will go around 2%. But if you're really confident of a trade, or you've traded here at 2%, and you're even more confident now, and you think, you know what, the trade's going in my favor, I want to add size to this position, then you can definitely look at that again, add a second position with maybe 2% risk. And so the position size is larger, the max potential drawdown, you can keep it at the same stop loss, but if the trade's moved in your favor a little bit, maybe put the stop loss up a bit, that can give you a bigger position size. What I can do here is show you. So for example, if you wanted to risk 2% right here, you can see the max amount that I can trade now is 0.12 BTC. How about if I move the stop loss up, right? So our open position size is this price, that's what we got in at. But what we want to do is move the stop loss position up $1,000 to 19,000. You can see the unit trade size is going to get bigger. So we'll calculate that. You can trade a much bigger position size. Why is that? Because your max potential drawdown in terms of dollars compared to your account balance is now smaller. You know, the max drawdown from, let's call it 20,000 to 19 is $1,000. If you put this out to 18, you're now risking $2,000. And so if you're only risking a set percentage of your portfolio, that trade size has to be smaller. So these can be manipulated dependent on how confident you are of the trade, what type of position you're in and everything like that, the rest of your account balance. And so, that's up to the individual trader, but that's some things to think about when going into an actual position size when using leverage. Now what we can do is actually enter the position based on the parameters that we've got, based on how much risk we want to take, what the stop loss is, what the max potential drawdown is. Remember, everything with leverage is done on your max potential drawdown. Like in the worst case scenario, how much are you going to lose? That dictates how big your position size will be, rather than just using X amount of leverage and leveraging up. Now that's possible as well. If you want to speculate, you can do that. So that's up to you. You don't have to use 2% risk. You might say, actually, I want to risk 6% of the portfolio. And so your position size is a lot larger. So you can do that and obviously use more leverage to, get position sizes up, or potentially just fund the position with more of the cash and use less leverage, right? So all of that is up to you in terms of your risk tolerance. So on the right-hand side, you can now simply enter this position. So we're going to go for a limit order here, and you'd put in the amount right here, which is what, 19,663. So you can do that, or you can just go to last. You can do a market order as well. I think market orders are decent in the futures market because the spreads are so tight. So you're not going to really be missing out by using a limit order. Limit orders may get cheaper fees on some platforms. So you may want to use a limit order here, go to last, or go to, this one down here, which is the kind of bid side if you're going long. And then the size, as you can see, it tells me here. So let's risk 3% of the portfolio. $10,000 portfolio. We're going for a 0.452 position size. So come back 0.452. So that would be your position size. And again, if you want to move the stop loss down, your position size is obviously going to change and get smaller. So what you can do now is enter a take profit and stop loss if you want. When I'm trading futures, or if you're going to trade on leverage, I would always suggest a stop loss at least. Take profit is not required because you may want to let the trade play out. You may want to add to it later. You can do that here. A stop loss is probably good. Now, if the market is moving really fast, just go for a market order and don't put any of this in because you're literally not going to have any time. But if you're trading and the market is moving quite slowly, you can definitely put this in. A stop loss is this bit here. It's the max potential drawdown. It's really important to put in because you're taking your position size and your leverage off of the max potential drawdown. And so if you don't put this in, then that's obviously going to change, right? So put that in, and that's the level that you've determined. So call it 18,000 or 19,000, and we had in the example, right? Something like that. Take profit again. You don't need to put it in right now. You can if you want. So if you identify an area that you want to take profits at, you can put that in and let the trade run out, or you can not do that. What you can do now is just go and buy long. So very easily. Now, if you want to go short, it's the exact opposite, where you're looking to sell first and then buy back later. So I'll show you that example. Because we're trading futures, we can actually sell first and buy back lower. So this is a great way to take advantage of prices coming down, and it's the exact opposite. So you can work out the exact same position sizes here. So we're going to take this long position off, and we're going to go over and enter a short position. So you can get that short position here, and we can do it on exactly the same chart. So we're going to enter at exactly the same level. So that was around, let's call it, 20,000 just to make it easy. Now you can see this red is at the top and the green's at the bottom. Now remember, we're in a short position. So what we're actually doing is selling first, or we're entering a position that sells short, because we don't have any actual Bitcoin here, but we're selling first and we want to buy back lower. So just as an example, you can put your stop loss a little bit above based on technicals, and then you want to buy because there's going to be a dump. You want to buy it back and finish out the position to sell first and buy later, sell high, buy low, the exact opposite of a long position. So we can do exactly the same thing, going to our position calculator, knowing that the open price, 20,000, stop loss price, let's call it 22,000 like this, and calculate, and it's going to give you the exact same. Now, I think this calculator works it out. If your open price is below the stop loss price, it works out that you're in a short position, right? So again, there's a 10% difference here, right? And then it works out how much your account balance is and how much risk that you want to take. Position size is 0.15. So what we can do now is go back and put the exact same trade in. So you have a limit order around this level. You want to go on this side. You can put the amount of BTC in. So that was it, 0.15, whatever that position is. From here, you want your stop loss, of course, above your entry. So 22,000 or something. Now you can sell short. Now you're in a position that benefits if the price goes down and is in a loss when the price goes up. So that's how you buy long and buy short in the futures market, with the margin calculation the same either way. That's the basics of using leverage. If you want a more professional outlook with some strategies, check out the Crypto Investor course. I'll link it down there. You can see all of the guides and videos in there. There's like 200 or 300 in there. Check out the deposit bonuses as well down in the description. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.